Hey, this is Josh High here coming to you from Swift Home Mortgage, and I wanted to tell you about a new program that just came out yesterday. It's getting a lot of questions and a little controversy in our market, in our industry. So you may have heard about it already. If you haven't, we're doing a 1% down conventional loan option. This is a form of down payment assistance. There is a grant coming from the lender. So you're going to be in a regular 3% down home possible loan product, Freddie Mac product. You're going to bring 1% as the buyer, and the lender is going to cover the other 2%, getting you to your 3% total down payment. So this program is for a lot of people, and it's also not for a lot of people. So I want to go through the details, give you the announcement, show you what to look out for. If you're a realtor, feel free to share this with your clients. This is going to answer a whole lot of questions, and I hope to educate you about this from top to bottom. So this might be a little bit lengthy, but hey, that's okay. You're trying to buy a house, right? So the new down payment assistance program available to income qualified borrowers. That is going to be the biggest challenge in this whole program, is that the income qualification is pretty strict. We'll get to that in just a second. 1% down from you, 2% down from the lender, 3% total. All Freddie Mac Home Possible guidelines do need to be observed here. The good thing about that is it comes with reduced LLPAs, which is a loan level pricing adjustment for different things like debt to income ratio, loan size, loan to value ratio, different things. That LLPA is a whole other topic. We can get into that later. It helps to incentivize our lower income borrowers and people who are just having a hard time trying to break into the housing market. The lender grant that you receive, that 2%, is not repayable, and it's just what it says. It's a grant. It's not going to stick around like a second mortgage or a silent second that hangs out like a lot of the more traditional down payment assistance programs. So it's a really good deal to go ahead and get some extra money without having to worry about paying that back. Now let's get into the details. This is going to be for a 30-year Freddie Mac Home Possible conventional fixed rate only loan. So we're only looking at your standard 30-year mortgage, no ARMs, no 15 years, no different terms, just your vanilla loan. The down payment grant can cover up to 2% of the purchase price with a max of $4,000, whichever is less. So if you're buying a $200,000 house, you're going to get a 2% credit, and it's going to be $4,000. If you're buying a $300,000 house, 2% would be $6,000, but they only max out at $4,000, so you would have to come up with that additional $2,000. So you can look at this, depending on your price point, as just a $4,000 credit, or it could be a 2% credit if it's under that $200,000 purchase price. All Home Possible guidelines must be met. There are some restrictions there on debt to income ratio and some other stuff that we can get into, if we get the file and really dig into it. So just be aware of that. 97% max loan to value, which is 100% is the purchase price. Take away 3% down payment equals your 97% loan to value. Loan Prospector, which is Freddie Mac's automated underwriting system, must return to us as accept eligible. We can't have any refers. We can't have any manual underwrites on this. This all has to slide through automated underwriting, just as it's packaged. So it's going to be a pretty clean and vanilla deal to get through here. Maximum debt ratio is going to be per automated underwriting findings. We do know that Freddie Mac is going to have a Home Possible cap of 45% on the back end on this product. So we can't push to 50 like we normally would on a conventional loan. That's going to be a little bit more restrictive on that. So that's really something to pay attention to. And 45 is not the automatic cap. We could go a little bit less if other factors prevent us from going up that high to 45%. So we might cap at 41. AUS might tell us it needs to cap at 42. We really need to run the automated underwriting system to know exactly what we're going to get into there. So that is sort of a to be determined. Maximum loan amount is just going to be our normal county loan limits for any other conventional loan. So there's no extra loan limits here. The only problem is what I just mentioned before, is if you're buying over $200,000, this turns into a $4,000 credit versus a 1% down program. So keep that in mind. Maximum rate lock period is going to be 90 days. So no super extended locks or anything like that for a new construction loan. 3 months is as far out as you can go. 2 to 4 units, your duplexes, triplexes, quadplexes, and manufactured homes are not allowed under this program. So if you have buyers out, or if you're looking yourself for manufactured homes, we can definitely do those, but not on this product. We're gonna have to put you into something else. Okay. This is only available to borrowers who are under 50% of the area median income based on the property address that you want to purchase. Now, AMI, is what we refer to it as, area median income, is published out there. There's websites. I'm going to include a link in the description below that you can plug in property addresses. You can click around a map and look by census tract and see what your AMI is for the area that you're looking in. So some common places here in our area and other parts of the state: Lithia, Florida, where Fishhawk is, they have an $82,100 area median income. That's the published AMI for that count for that area. 50% of that, which is the cap for this program, is going to be $41,050. So that's going to be your maximum earning for the borrower when they're buying this house, $41,050. And Mulberry, it's a little bit lower, $60,500, and that 50% of that is $33,750. Davis Island is going to be the same as Lithia, $82,100, even though that's where Brady and Jeter were. That's still $82,100. So $41,050 is going to be the cap for income on that in that area. And then Homosassa, we do a lot up there. $68,600 is the AMI, and 50% of that's going to be $34,300. Now, I urge you to go and look in this AMI lookup tool, because that's really where you're going to find your area. If you're looking at a house, plug the address in. It's going to tell you exactly which census tract that house sits in, and it's going to give you a highly accurate number that you can use to look this up. Borrower eligibility. So homeownership counseling, a course is required for any borrowers who are a first-time home buyer. So if we can show that you've owned a home in the last 3 years, we can waive that course. If you've never bought a home before, it's been over 3 years ago, Home Possible makes you go through a self-paced class, a little course just to show you the benefits and the downfalls and dangers and things to watch out for, and just make sure you're educated before signing up for a mortgage and getting into a house payment. That's what that's there for. Normal loan application and processing requirements are all still in play. This is just some extra things that we go through to get this program in place for you. Did some examples here just to show you how the math works and to show you how this can be used. So I did some searching online earlier. I found a house for $150,000 for sale in Lake Wales, and that AMI, that area median income there in Lake Wales at this house, is $60,500. So we cut that in half, take 50%. $33,750 is our max income that one can make to be able to fit into this program. So 3% down payment on that $150 purchase is going to be $4,500. Take away that 2% lender grant for $3,000. 1% from the borrower is going to be $1,500, so a $1,500 down payment. Estimated closing costs, took a rough number of about $5,000 on that. So your total cash to close out of pocket to get into this home would be $6,500. Now, if we go and add some seller concessions that were negotiated through the contract, if you could get that, let's say that they give you 3% seller concessions, that's going to be another $4,500 applied, and then you're going to wind up with a total of $2,500 out of pocket. So once your seller concessions kick in and then the lender grant kicks in, that's going to reduce you down to buying a $150,000 house for $2,500 out of pocket. So I think that's a pretty good deal, especially if you're looking at that price range and you have the ability to make this work. Now let's look at how this payment's going to be made up and what our debt to income is going to look like. So on this same scenario, $150,000, again, our qualifying income cap is $33,750. The borrower's income in this made up scenario is $33,750. We're just going to take that top number, divide it by 12, get their monthly income of $28,12. That's their monthly income that we can use to qualify. And the credit score we're basing this on is going to be 680. That's what we use to pull interest rates on this. So the principal and interest payment that we wind up with is going to be $907 per month. The rate's going to be 6.375, 6 3/8, with an APR of 6.931. Okay. Taxes, we're going to see on the listing, it's $500 a year. Insurance estimate, $1,500 a year. That comes to $166 a month in your escrow payment, which is part of your PITI, principal, interest, taxes, and insurance. Your PMI on this, your mortgage insurance, is going to be $86.09 per month for a total housing payment of $1,160.68. All right. Now, if we assume that this borrower has zero to very little debt that they pay for, credit cards, student loans, car payments, anything else, let's just say that this person doesn't really have anything that they're paying for outside of the mortgage payment they're signing up for. That's going to get us a debt to income ratio of 41.2%. Okay, that's within range of the program. And if we got our automated underwriting approval on this, it'd be smooth sailing from here on out. Okay, let's look at another example. I found another home in Zephyrhills that is for sale today. $215,000 is the asking price on it, so that's what we're going to put down for purchase price. The area median income in Zephyrhills happens to be $82,100. Half of that, 50%, is going to be $41,050. So that's going to be our cap, as high as we can go. That's as much the money that the borrower can earn. Is that $41,050. 3% down payment, $6,450, $6,450. Lender grant is going to be $4,000 in this case, because 2% of $215,000 equals $4,300. And like I said before, the max dollar amount is going to be $4,000. So they're going to turn into a $4,000 credit instead of just a 2% credit. 1% down from the borrower is going to be $2,150, plus that extra $300 that the grant can't cover. So the down payment from the borrower is going to be $2,450. Okay. Estimated closing costs in this case, again, rough estimate, about $6,500. So a total cash to close walking into this with no seller assistance, looking about $8,950, $8,950. Now, if we can get seller concessions negotiated, 3% again on the purchase price, that's another $6,450 that seller's going to pay on our behalf. And your total cash to close now is going to be $2,500. So to walk into a $215,000 house for $2,500, still feel like that's a pretty good deal. All right, now let's take a look at the payment breakdown on that scenario. So we're back to our income, $41,050 is their max income. This borrower makes just under that number at $41,000 even, or $3,416 per month. Now, principal interest payment on this is going to be $1,267 at a rate of 6 1/8, APR 6.666. Taxes, $1,200 a year. Insurance, $1,500 a year for $225 a month in escrow. PMI on this one at the higher loan amount is going to be $123.39 per month for a total payment of $1,615.39. Now, assuming the borrower, again, has none to very little debt in their debt to income ratio, their back end ratio is going to be 47.2, which is going to put them at out of range for this Home Possible product. So this is where it gets sticky. We're going to have to dig in deeper, see what other kind of programs are out there that we might be able to help with and get them something that's going to work better for their situation. So that would be a no-go. Now, who is this product for? This is, as you've seen, a very income restrictive program, and they're tight, but they're suitable for some areas. So some people in the state will find this beneficial and can take advantage of this. Florida home values do remain strong, inventory remains tight, and that reduces the availability of the houses that people at a 50% AMI can afford with their debt ratios. Program makes sense in some situations. There are people out here who it will work for. Borrowers who have little to no other debt on their debt ratios, and they still qualify under the Home Possible guidelines. That's who we're looking for. Those people who are able to keep their debt low and be able to afford the new house that they're trying to buy. That's who we're looking for. Those are the people that are going to qualify for this. Who is this not for? This is not for anyone earning over 50% of their area median income. Buyers with a price point of over 200,000. You know, maybe 230 might make sense. Maybe 300 might make sense. You're still getting a $4,000 credit, but once you start getting up above that, the math is just not going to work for a buyer of a $400,000 house to also fall within 50% of their area median income limit. So it's not going to work. The math's not going to support it. So pretty much buyers at a price point under 200,000. Who else is it not for? FHA or VA buyers who need those programs for various other reasons. FHA is going to be a little bit more credit challenged, going to let people through that's got a little bit more credit challenges, a little bit more lenient on credit scores, lenient on debt to income ratios, things of that nature. So FHA might be a better option if we can settle the down payment. If we can find some funds through a gift or through savings or through money ready to go, then FHA might be a better option than this. It all depends on the borrower. VA is great loan all around, from low income to high income to low price properties to jumbo properties. VA, if you have a VA loan, you don't even really need to be looking at this 1% conventional down payment option because it's not applicable to you. Stick with your VA loan. Borrowers with sufficient funds to bring 3% or more. So if you've got money, you've got savings, if you've got 401k, you've got family gift, you've got equity from another sale, use it on your new house. Don't have to go through all these extra hoops and this extra scrutiny and these reduced limitations on this program if you have the money to get into it. So that's who it's not for. Now, what do you do to get started with this? How do you research this and know, is this program going to work for you? This program is not available to all banks and lenders. We're part of an exclusive program offered by one of our wholesale lenders, and this is kind of a niche product in the market, and not everybody has it. So it's also offered only for a limited time. So this is probably going to go on for a few months, and then they could pull this away. So if you're interested, you're going to have a window through this spring and summer market to really kind of take advantage of this. But you know, it's not going to be around forever. We already know that, but we don't know when it's going away either. So just keep in mind there. There's lots of moving parts, lots of dots to connect, lots of hoops to jump through. This is not typically something that you can figure out on your own at home unless you know that you're making more than that 50% AMI. That's your immediate disqualifier. But if you're under that range and you have more questions about it, you don't really know where to go to fix the situation, let us take a look at it. We'll be happy to run through your situation and look for a path to get you to this product. And if we can't get you there, we'll give you some alternatives and show you what you can qualify for in the meantime. You can reach us at 813-606-4255. We're here to answer any of these questions for you, go over all the products and options, and give you what your purchasing power is when it comes time. Realtors, I'd urge you to share this with your clients, people who are looking for this. If they've heard about this program, this is also something you can share with them to show them, you know, some other things that are available that might make your clients open up to another program, or maybe we're going to be able to get somebody approved that we couldn't before. That's why I'm putting this out here, just for your information. You can visit us online at swifthomemortgage.com. There's some contact us on there. Our phone number, our email, everything is on that website. If you need me for anything, feel free to reach out. My name's Josh High. I'm the broker, and I own the company here at Swift Home Mortgage. Here to help. I hope you found this information useful. If you wouldn't mind going ahead and liking this video and subscribing to our channel. We put out tons of content on mortgage education and helping our realtor partners and helping our clients and everybody win in whatever market that we're in. So please like and subscribe. If you need this for anything, we're here. Thanks for watching and have a good day. Bye-bye.